Welcome back to Dr. Finance. This is a paper by Professor Leontief, who won Nobel Prize in Economics in 1973. And this is a paper he published in the Review of Economic Studies in 1936, titled Quantitative Input and Output Relations in the Economic System of the United States. Introduction. The statistical study presented in the following pages may be best defined as an attempt to construct, on the basis of available statistical materials, a tableau économique of the United States for the year 1919. 150 years ago, when Kesney first published his famous schema, his contemporaries and disciples acclaimed it as the greatest invention since Newton's laws. The idea of general interdependence existing among the various parts of the economic system has become by now the very foundation of economic analysis. And yet, when it comes to the practical application of this theoretical tool, modern economists must rely exactly as Kesney did upon fictitious numerical examples. What would be the present day of the theory and policy of international trade if instead of actual balances of foreign trade, the economist had to base his analysis upon assumed numerical setups, supplemented by scattered items of actual statistical information? This is a situation in which the student of economics finds himself at present, when he faces a problem of national production, consumption, and distribution, despite the remarkable increase in the volume of primary statistical data. The proverbial boxes of theoretical assumptions are in this respect as empty as ever. Considerable progress has been achieved in the field of national income statistics. The economic balance of some of the most important branches of the national economy, particularly that of agriculture, has been studied with much success. Thus, the ground has been prepared, at least in part, for more complete analysis of the interrelations of the whole economic system. Nevertheless, the difficulty of the task still remaining can hardly be exaggerated. The publication of this preliminary survey is prompted by the conviction that the inevitable path of any empirical research is that of trial and error. Governmental publication constitute the main source of primary statistical information used in this study. Additional data were gathered from the trade publications, and in some instances, the results of special investigations have been utilized. In many cases, use was made of the work of National Bureau of Economic Research on National Income. At the time that this study was initiated, 1932, the publication of the detailed results of the 1929 census was still far from complete. As a result, the census of 1919 had to be used. It is because of this fact that the entire investigation is based on 1919 data. Chart 1, series indicative of business conditions. Bank debit outside New York City, production, prices. The general business conditions prevailing during that year are described in W.L. Thorpe's Business Annals in the following terms. Revival, prosperity, uncertainty gives way to extraordinary activity, late spring. Building revival, enormous output of new securities, speculation, steel, coal, and railroad, shopmen's strikes, autumn, commodity prices rise, active foreign trade, money eases slightly but tightens late in year, stock exchange booms, railroad reaching peak, May, and industrials, November, falling bond prices, Embargo on gold export removed. June. Large wheat, fair cotton and corn crops. Prices very high. The position of the year 1919 within the framework of cyclical fluctuations of adjoining decades is fairly well indicated by the three basic economic series presented on chart 1. The theoretical scheme and its statistical application. Fundamental concepts. 1. The theoretical basis of the subsequent statistical analysis is rather simple. The economic activity of the whole country is visualized as if it were covered by one huge accounting system. Not only all branches of industry, agriculture, and transportation, but also the individual budgets of all private persons are supposed to be included within this system. Each business enterprise, as well as each individual household, is treated as a separate accounting unit. A complete bookkeeping system consists of a large number of different types of accounts. For our particular purpose, however, only one of them is of importance: the expenditure and revenue account. It registers on its credit side the outflow of goods and services from the enterprise or household, which corresponds to total receipts or sales, and on the debit side, the acquisition of goods and services by the particular enterprise or household, i.e., corresponding to the total outlays. In other words, such an account gives a description of the flow of commodities and services as it enters the given enterprise or household through one end and leaves it by the other. In contrast to a balance sheet, this type of account is related not to a single instant, but rather to a period of time, say a year, a month, or a week. It differs from the usual profit and loss account insofar as it includes all sales and all purchases. In the case of purchases, it includes not only those representing expenses in the accounting sense, but also capital outlays, etc. Our expenditure and revenue account covers, in the words of the entire balance of trade of the individual enterprise or household, profits paid out to the owners, as well as expenditures connected with additional investment in plant, etc., are supposed to be debited together with payments for all the for all the current operating expenses, purchases, replacements of machinery, etc. Purchases made on credit or paid for with borrowed money are also entered, along with all other expenditures on the debit side, while the sales, even if made on credit, are credited in the same way as are the cash sales. The expenditure and revenue account of this kind may show over a period of time a negative balance, sales smaller than purchases, only to the extent that a given household or enterprise disburses its previously accumulated cash, bank balances, or other negotiable titles, or spends funds obtained by additional borrowings. A positive balance, sales greater than expenditures, on the other hand, can result from an accumulation of cash, repayment of debts, or an increase in bank deposits or security holdings. The structure of the expenditure and revenue account thus described is very similar to that of the balance of trade of a country. It covers explicitly all the commodity and service transactions, but not the so-called capital items. 2. It follows from the obvious nature of economic transactions that each revenue item, as defined above, of an enterprise or household must reappear as an outlay item in the account of some other enterprise or household. This consideration makes it possible to present the whole system of interconnected accounts in a single two-way table. Table 1. Distribution of outlays, input. Distribution of output, revenue. The capital letters A, B, C, D, and E indicate business and household units. Each row contains the revenue output items of one separate business or household, subdivided according to the origin of revenue, or what amounts to the same thing, the destination of its products. The figures in row A, for example, show that the product of firm A was distributed during some specified period of time in the following way. The amount B was taken by the firm Big B, the amount small c by the firm Big C, and the amount small d and small e were sold to the firms Big D and Big E, respectively. The last item, sigma sub A of big A sub I, represents the sum total of these separate entries and shows the total revenue or production of firm A. In a similar manner, the subsequent rows show the production revenue distribution of firms B, C, D, and E. If read vertically, column by column, the table shows the expenditure side of the successive accounts. The last item, sigma sub A all the way up to E of small I sub small a of the first column shows, for example, the total expenditures of firm A. The entries above it in the same column indicate the distribution of these expenditures among all the different sources of supply. B sub small a was obtained from Big B, C sub a from Big C, etc. The succeeding columns reveal the cost distribution of the firms B, C, D, and E. If it contained empirical data, the table would naturally have a number of empty squares. Those lying along the main diagonal are necessarily left open because our accounting principle does not allow for registration of any transaction within the same firm. Actually, no firm or household exists which sells its products or supplies its services to all the other households or firms, and which makes its purchases also from every one of them. This means that not only the diagonal but also many other boxes of our revenue expenditure table will remain blank. The grand total of all transactions, big S, placed in the lower right corner, may be obtained by adding up the revenues of all the different firms as shown in the last column or the expenditures as listed in the last row. Although, as was pointed out before, the credit and the debit side of the account for each particular enterprise or household will not necessarily balance. The total expenditures of all the firms and household must, for obvious reasons, equal the sum total of their revenues. The simple system of letters and the simple system of letters and subscripts used in the present description leads to an abridged method of identifying each separate box of the combination table. Box big AB is situated on the intersection of row A and column B. CD defines the squared a square belonging to row C and column big D, etc. The statistical research, the results of which are presented in this paper, has been undertaken with the definite aim of supplying an empirical background for the study of interdependence between the different parts of our national economy on the basis of the theory of general economic equilibrium. These results are incomplete. In many respects, they are open to criticism, and certainly subsequent revisions will modify many important details of the picture. Work on a similar tableau économique for the year 1929 is already underway. But even the available material, however imperfect it may be, seems to justify a laboratory test of the pertinent theoretical formulations. Such an attempt will be presented in a later article. The statistical data collected in our main table fill in the empty boxes of the theory of general equilibrium. Hypothetical production and consumption equations gain explicit meaning as soon as the symbolic algebraic signs are replaced by observed numerical values. Once an empirical foundation is thus established, the vague generalities of abstract theoretical statements will acquire concrete empirical significance. Thanks for listening.